Let's now turn our attention to the banking sector. The banking sector has seen the biggest re-rating in the last 3 months. Compared to the other sectoral indices, the Nifty Bank has recovered 25% just in the last 3 months. The Nifty Bank was at a level below 33,000 3 months back, and now it's very close to its 52-week high. We've seen an improvement in India's macro. There has been some, multiple re-rating. The credit growth demand has also been very strong. The latest one shows that the credit growth stands at 15.5%. From the sidelines of the JP Morgan India Investor Summit, we're now joined by Saurabh Kumar, the Executive Director of Banks and Financials Research at JP Morgan. Thank you very much for joining in, Saurabh. First, if you could tell us, have you had any conversations with banks, the financial institutions, and what has been the biggest takeaway from you from this conference now?
So thank you for inviting me. I think the biggest takeaway is essentially on growth, that we are seeing, as you rightly pointed out, credit growth has gone up to 15.5%. And there is actually upside surprise coming in. So hopefully we look to a very good festive coming through in October. But the broad takeaway is that the growth estimates probably could be revised upwards for the system. On the more negative side, I think the concern is essentially that the deposit growth is still weak. So to fund the credit growth, effectively, maybe there will be rate hikes which will come through on the deposit side. And that could then start to pressure NIMs maybe next year onwards. So near-term NIMs go up, but on a more medium-term basis, NIMs could come down. But I think the positive is essentially on the credit growth piece.
Why is it that deposit growth has been weak?
So, one is obviously that effectively the deposit rates are, because of the policy action by RBI over the last 2 years, have kind of come off. So savers have moved to alternate investments. So we have seen some piece of that play out in the at least on the retail deposit piece. So that's one. Secondly, the credit creation before that was also weaker. So that has a lag on deposit growth, which is what we are seeing. Hopefully with the lag as credit growth picks up, even the deposit growth will also start picking up.
Right. Hi, Saurabh. Good morning. So you were just saying that, the net interest margin might go up in the near term, but in the medium term, we could see a little bit of a hit. Could you tell us how much of a hit you're factoring in on the margin?
So if you look at the banks, the incremental credit deposit ratio, especially for private sector banks, has started to get stretched. It's well above 100% for almost all of them. And also the private banks have used excess liquidity on their balance sheets. So by next year, we would imagine a 10 to 15 basis points compression could happen. But for every bank, the number is different. It's not uniform across all.
What was the takeaway from the banks when it comes to the asset quality? Because the 2-year window for restructuring will come to an end. How much of it can slip into NPAs? What has been the feedback on asset quality? Can you talk a little bit more on that?
So on asset quality, what's very clear is that the credit provisionings have normalized. In fact, they could go to below normalized levels because the corporate asset quality picture is very, very strong. So we will see probably below normalized provisions essentially happening because a large piece of the system, which is the corporate sector, is very clean at this point of time. There will be slippages from the restructured book, but we have to, if you look at most banks, are also sitting, at least the private sector are sitting on excess provisions. So there is in some sense, buffer to draw down on. So the net impact hit to the earnings, so the P&L will not be very high. So the absolute credit provisions, depending again on the bank, should be 1% or below, at least for the private sector. And even for the public sector, we should see a very sharp normalization downwards.
Saurabh, we have been discussing, the retail loan growth. How much do you expect this to go up? Of course, we are in a rising interest rate cycle, but we also do have the festive season, which is, pretty much around the corner. So how do you see retail loan panning out for the rest of the year?
So if we look at the retail piece, we would expect a slightly higher growth, which is about 16% because if you look at the biggest exposure of the retail sector is essentially into mortgages, where the property cycle after a very long downturn is starting to pick up. And that is where, even as a house view, we are very constructive on the cycle pickup, at least on the mortgage side. And that is where we think the cycle can sustain. It can actually run at 16-17% for a much longer period of time now.
You know, up until now, Saurabh, the credit growth for banks has been driven by working capital requirement. We haven't seen a broad-based pickup in capex. What is the feedback that you're getting from banks, and what could be the extent of the upside surprise to credit growth? What are your own numbers at?
So yes, there is hope that the capex will pick up. The conditions have fallen into place, but we have to recognize that the macro, there are some challenges as well. But at least what we are hearing is that most of the corporates have at least started making the announcements. From announcement to drawdown, there will be a lag. It may not happen immediately. Hopefully, this will be a next year situation. But we should certainly see the large industry credit growth, which is running at roughly 3% hopefully should move to about 8 to 10% odd levels by next year.
So
that will basically aid the credit demand upwards.
Okay, so what is your credit growth forecast for this year and next year?
So this year we are at 14% for the system. Next year we are at about 16%.
And this includes the 16% forecast for next year includes a pickup in capex.
A modest increase in capex. Yes.
Saurabh, just one final question before we let you go. You know, within this space, which are you more sort of positive on the PSU space, on the private banks, and also if you could just run us through some of your top calls in the banking space?
Yeah, so what we are seeing on the system is essentially the constraint is just shifting from asset quality to liquidity, which is deposits. And if you look at public sector banks, they are deposit rich. So in some sense, the PSU banks do look very good as investment opportunities, but will be very selective within that space. So as of now, our top picks are Bank of Baroda in the PSU space. We have Bandhan and ICICI Bank. And in the NBFCs, we have Bajaj Finance.
What is your view on, if NBFCs will get to issue credit cards? There's been a lot of back and forth on it in media.
So it's unlikely. We'll have to see what the Reserve Bank eventually decides. But at this point, it does not look something which is very immediate to us.
Okay, not very imminent. Saurabh, thank you very much for joining in, and have a lovely conference. Thank you for joining us.